Alex, welcome.
Hey, Spencer. Good to be here.
So what determines the price of financial assets like stocks? Is it, deep information on the intrinsic value of assets, or is it just vibes?
So the theory of financial markets has a very clear answer, right? So it's the discounted flow of future value of each company. People in a market have some information about it. They bid on these assets. Some people are selling, some people are buying. And then the ultimate price with like the invisible hand, the price is the intrinsic value of the company. That's kind of the...
I just to unpack that. So you're talking about future cash flows. So, right, if I buy a stock and I project out that, in 1 year, it's going to pay $1 million to shareholders, and then the next year, another million, you kind of take all those cash flows into the infinite future, add them up, discount them back, and that's kind of the worth of the company today.
Yeah, and that's what determines the price. That's like the basic asset pricing model. But, there's another model that you could think of, which is the one many of your audience is probably familiar with by John Maynard Keynes, where the stock market's a beauty contest. So for those of you who don't know this like very colorful story, back when he was writing, there used to be these beauty contests in the newspaper. And essentially, what's the contest? There's a bunch of pictures of usually women, and you had to pick the picture of the woman who everybody thinks everybody else would also pick. So essentially, you kind of had to think about like who. It's not necessarily who I think is most attractive. Who do I think everybody else is most attractive? And he said that the stock market was just like that. It's not really about the fundamental value of the company or anything like that. It's about me thinking what other people are thinking is the stock that everybody should buy.
Right, and it gets recursive, right? Because if I'm trying to model what everyone else is thinking, but they're trying to model what everyone else is thinking, everyone is just kind of, you get this recursive thing where you're like, okay, but what is it all based on at the end of the day?
Right. So it's kind of like, Tom Schelling has this idea of Schelling points. It's like all of our decisions are based on what I think everybody else is going to do. So I have to kind of look out around the world and think, that's a little kind of focal point that I think other people are going to notice too. And if they notice it, they'll know that I notice it. So that's where I should go, or that's the stock I should buy. And that's a really different model of the stock market.
So what would a real example be where people would kind of coalesce around one aspect that has nothing to do with the intrinsic worth of the company, but is something salient?
I mean, GameStop, that's a good example, right? So GameStop was this little brick and mortar shop that was selling video games, not doing very well. And somebody, on Reddit or some other forum said, hey, it really sucks that this like childhood store that we all love is going into the tanker because these private equity guys are trying to destroy it. Why don't we all kind of just buy it? What's going to happen? And guess what that is? That's a Schelling point. That's a focal point. All of a sudden, everybody else starts looking at that article thinking, other people are looking at it, other people are going to buy it, I should buy it. And then all of a sudden the stock pops. And that value of the stock, as many of you remember, and you probably have seen not only kind of the news articles, but there's also a Hollywood movie called Dumb Money about GameStop, that the price not only popped, it stayed high. It's still high. So it's not like this like little blip that went up and all of a sudden it's gone. This sort of thing that has completely divorced from the fundamental value of the company can sustain prices for a very long time.
Yeah, because in a standard economic perspective, you could say, well, of course there's going to be deviations from perfect rational market sometimes, right? But they should course correct. Once actors realize that there's a deviation, people are going to go in and either buy or sell to make the price correct, and then sort of everything's back to sort of this rational agent model.
Right. That's the idea. But in theory, it doesn't really have to work like that. If nobody sells, the price doesn't go down. It doesn't correct. People need to actually start thinking like, oh, actually, there's the discounted cash flows are actually really bad. I'm going to act on that information and sell. But if a lot of people's wealth is kind of tied to the fact that we should not be selling, and we're coordinating on the internet very publicly not to sell, maybe the price is not going to correct itself. And it hasn't in many of these cases.
I believe it was Warren Buffett who had a quote that in the short run, the market is a voting machine, but in the long run, it's a weighing machine. And I think the idea there is it's trying to say, yes, there are these anomalies in the way people value things. But in the long term, if you wait 10 years, it all kind of equalizes. Do you think that's true?
I think that there's definitely a large grain of truth to that. But I mean, the issue is that when is that kind of long run prospect going to actually occur? Maybe it's 10 years, maybe it's 20 years. In 30 years, let's say the price of GameStop corrects itself and a bunch of people say, see, I told you, everything corrects itself. But meanwhile, 30 years has gone by. Countries are born and die within 30 years. It's a long time. So the fact that people, don't really know when these prices are going to correct is a big problem for asset pricing.
Yeah, what's that other famous quote? The market can stay irrational longer than you can stay solvent.
Yeah, exactly. That's a great one. That's the limits of arbitrage. It's everybody says, well, there's going to be these smart guys who are going to be shorting the stock, but what the problem with holding a short position is, if you're kind of out of that position and everybody else is still holding, you go bankrupt.
One thing I've noticed that I found very worrisome is that imagine you realize things are in a bubble, like their valuations are completely detached from reality. They make no sense. Like, for example, maybe it's the year 2000, the internet stocks are getting these crazy valuations that you can't possibly be justified based on the amount of money the stocks are going to make. And you're right. But the problem is, like, how do you actually capitalize on being right? Because if you can't capitalize on it, then you can't put a market pressure to make things more rational. And, what are your options really? Well, literally you could buy options, right? That's one possibility. If you do that, the problem with that is, yes, you can make a bet that the market is being irrational. But first of all, there's often a lot of volatility, so the options will cost a lot. And second, you have to time things because you need to say not just that it's irrational, but you have to make an estimate of when it's going to become rational. And if you give yourself a really long time frame, the options are going to be ridiculously priced, and it's not going to be worth it. So you essentially have to be a market timer, which is sort of defeats the whole purpose, right? Or you could short, and arguably shorting the market's even worse, because you short the market basically when it goes up, you lose money. But the problem is these stocks, well, what if it goes up 10x or 50x? And who can sustain losing 50 times their money? It's just a ridiculously unsafe thing to do. So is there really even a mechanism by which the market can become rational in those circumstances?
I mean, that's the problem with limits of arbitrage. This is a really beautiful paper by Andrew Schleifer and my colleague, Robert Vishny, basically showing mathematically that it's really, really hard to do that. And it's actually not a very good correction mechanism to say, look, there's going to be people on the other side kind of correcting the market. Here's a nice example. A lot of the formulas we use to price assets are based on the Black-Scholes formula. And this is essentially a formula that says, let's take kind of the risk of the asset, other sorts of characteristics, let's calculate the price. And this is still used all over the place. The people who created that formula, they started a fund. And they said, look, we know what the price of the stocks are. If we see any mispricing, we're going to short it. We're going to try to correct the market, and obviously we're going to make money. Guess what happened to that fund? It went bankrupt very quickly because, you just can't time the market like that. And if people know they can't time the market, people are quote unquote irrational. I don't like using that word. If you're making money, are you irrational? Or do you know something that other people don't? Essentially, they kind of went out of money and the fund doesn't exist anymore.
Well, that's an interesting question, right? If is it really irrational if you're making money on it? But I think the reality is a lot of these kind of bubble type scenarios where an asset goes way up in value and it's disconnected from the fundamentals of that asset, they're kind of like Ponzi schemes where it's sort of like, or a game of hot potato. It's like it's been going up, so you buy it hoping it will go up, but then you've got to sell it to someone else before it falls, right? And then you don't want to be the one holding the bag. And the reality is I think a lot of times most market players get hurt really badly, even if a few people make out like bandits.
Yeah, no, that's exactly right. I think when you look at most kind of when these bubbles are forming, there's a lot of quote unquote smart money that tries to get in on it, thinking like, look, we're smart people, we're going to leave at the right time. And a lot of those people end up holding the bag and going bankrupt. So it's really hard to do it. So like, let's go back to GameStop. Once they did the analysis of who was trading, it wasn't these, Wall Street bet folks who were making a lot of those bets. It was institutional investors. So, smart money is getting in on this action. They know that the fundamental value is not the only thing that's going to be determining the value of the stock. So I think In finance classes, there's only one way to think about the stock market in terms of how each stock is going to be valued. But in reality, the people actually working in finance know that John Maynard Keynes was probably right at least some extent.
If we think about quantitative investment strategies, historically, some of them have based on trying to find companies that are misvalued, right? If you look at the actual worth of the company, it's not appropriate. Like, for example, maybe it's an ETF that's constructed from different assets, and you can say, well, it actually is differing from its true value, so we can buy it until the gap closes. But there's many quantitative strategies that have been momentum-based. Essentially, they're trying to figure out, well, what's moving, and let's just assume it's going to keep moving for a little while, and then we'll get out before it stops moving, right? And isn't this based on effectively some kind of weird psychological phenomena?
Oh, absolutely. I mean, what is momentum, right? It's such a powerful force in finance that it was taken as and incorporated as a factor into the standard models of finance because it's such a huge component of asset pricing. And the models just couldn't ignore it. And they said, like, look, actually, this is somehow a factor that should be used in asset pricing. But when you think about what is momentum, I mean, it's psychology.
And everyone is told, if you're investing, you've got to be fearful when everyone's greedy and greedy when everyone's fearful. But the problem is we're humans. And so we feel greedy when other people feel greedy. We feel fearful when other people feel fearful, right? So we are, unless you're kind of like a really, made in a really special way, or maybe you can, lash yourself to the mast and prevent your biases from coming to play, like chances are you're going to be consumed by many of the same biases as others.
And this is why things like Robinhood, which are kind of platforms theoretically set to democratize finance, allowing everybody to kind of trade for free. The problem is if people are biased, then, you're not really democratizing finance, you're democratizing kind of mistakes and getting people to lose a lot of money.
Yeah, and it might even go beyond mistakes to you're essentially telling people, hey, here's a sophisticated way to gamble that feels like you're doing the things that the big players are doing, but in reality, you're making not only very risky bets, but very probably bad expected value bets.
Oh yeah, I mean, there's a really nice paper by my colleagues at the University of Chicago Booth. What are retail investors buying on Robinhood? They're not buying index funds. They're not buying like a nice little package of diversified equities. They're buying crazy options. And they're losing tons and tons and tons of money to the institutional investors that are on the other side.
It's like democratizing hand grenades, right? It's not the best strategy. It also reminds me of in online gambling, which has become absolutely huge. What I've heard is that one of the most popular ways that they make money is by giving these crazy bets called parlays, where essentially they have almost no chance of winning, but the potential amount to win is huge. And it reminds me of these crazy options trades on Robinhood. Like in theory, you could make a tremendous amount of money, but actually your odds are really horrible. But that maybe that huge potential win is really enticing. And maybe you heard about someone else who had hit that huge win.
Yeah, and I mean the other difference between these parlays that we've always had lotteries that you go to the store and you buy a lottery. The thing is, that the chance is very low, right? When you go to the lottery to buy a lottery ticket. With these options, they're so complicated, you might not even know that the chances are so low. You might think that they're like moderate, and this is like, these are financial markets. Look, people on Wall Street are in financial markets. Now is my chance to get in on the money. You're not doing the same thing as the folks on Wall Street are doing. You're giving them your wallet. That's what you're doing. Yeah,
and with the lottery, I think, unless someone's super superstitious or something, I think most people accept that, like, on average, you lose money playing the lottery. Like, it's just very well understood. I don't know if people realize that with some of these options trades, especially because there's so many online gurus telling you their secret method. And people think, oh, there is a way I could actually beat the system with this.
Yeah, I can't tell you how many times I'm talking to somebody and they tell me, have you heard about trading on Forex? Forex is, this is like the exchange between currencies, and you're basically, who are you betting against on Forex? You are betting against the most sophisticated investors out there, and you're literally giving them money. I personally have research on Forex. It is a negative expected value bet. It is like going to the worst kind of casino. And there are seminars that you go to learn how to make money betting on Forex. That's the same thing as having a seminar about how to go to Riverside Casino and make money. You're not going to make money by going to Riverside Casino. It's the same thing.
So what are some of the implications of this idea that the stock market is not just about the true value of assets, but it's about this, Keynesian beauty competition?
Well, some of the implications are, again, something that we touched before, that it's really hard to kind of maintain discipline in a market. As in, when I say discipline, I mean having prices be somehow tied to the value of the company. When you have these forces that are completely divorced from these values, pushing the prices up and down. It also makes the market very unpredictable. Because again, you're not going to be able to kind of like put in all of these variables and say, this is what we think the situation is going to be. For all of those reasons, this introduces a lot more volatility and potential risk into financial markets. Once you start kind of thinking about these things on the more macro scale, where you're no longer thinking about kind of the fundamentals of the company or the fundamentals of the economy or the fundamentals of this and that, and instead you're thinking about what I think everybody else is thinking, all of a sudden these little tiny events, if they change enough people's perceptions of what everybody else is going to be viewing, I mean, things go boom.
So do you think it actually leads to greater large scale instability, like greater chance of market crashes?
Yeah, I mean, I think the idea is that that's exactly right. That you're going to be seeing fluctuations in markets where, you're getting into a situation where you look at the economy, you look at all the fundamentals, and you're like, why are things moving up or down? I don't understand. And then you realize that that's not really why they're moving up and down. They're moving up and down because people are thinking that other people are thinking that you should sell or you should buy. And so this makes it also very hard to do policy in those sorts of settings.
You also mentioned that it means that assets might be mispriced, but people might wonder, well, why does that really matter? Why does it matter that the stock market reflects the actual underlying, worth, this kind of cash flow worth of an asset?
So that's a great question. It kind of gets into like, what is the role of having a stock market in the first place? What is the role of finance? The ideal setting is that finance and financial markets allow capital to be allocated to the places where it has the highest return, right? So I am a company that has invested in my technology. I came up with a great idea. I came into the stock market. Everybody knows that this thing that I've invented is going to pop and it's going to be great. And they realize that and they should buy my company. On the other hand, the same thing, a company is sitting there completely a zombie, completely dead. That company should not get any more capital. That's reflected in the price. If prices are divorced from these sorts of things, then the full function of financial markets is really not there.
It seems like there's an underlying assumption there that if a company is making money, that it's providing some useful benefit to society. And obviously, you could debate the extent to which that's true. But if we start with that assumption, then we could say, if something's making money, it's doing some benefit to society. Therefore, we want financial markets to act in such a way that they provide capital to things that are able to actually make capital, right? And that things that can't actually make capital, don't get capital. Does that seem like the kind of the thesis? Yeah. So then I guess there's a question, well, to what extent is that really a good assumption that things that are making money are actually doing good for the world?
If the assumption of capital markets functioning the way they should is correct, then, that's exactly what should be happening. The companies that are making money are being productive. If prices are divorced from, companies making money are the ones that are being productive, then companies making money is not necessarily productive for the world. It could be a company that's doing something horrible and completely unproductive, but people think that they can make money by just buying the stock of this company because they saw it on Reddit. And in that case, the whole relationship and the whole kind of idealized version of financial markets as means of getting capital to companies that are productive, I mean, that whole thing goes out the window. You're in a lot of trouble.
The way I look at this, and I'm curious whether you would agree with this or not, is that if a company can make money by harming people, that's a really fundamental problem in society because people tend to be willing to make money. And if you're not willing to do it, maybe someone else is. And so if they're able to make money harming people, people will likely step in and do that. And then financial markets can actually be an engine of harm, right? Because they could allocate money to things that are making money but harming people. And so, in a well-regulated system, we have laws to try to make it as hard as possible to make money harming people, right? And insofar as the regulators are able to do that, then what's left over, the ways to make money are either neutral, and it's fine, not a big deal either way, or beneficial, right? Like you want the companies getting money to be the ones creating the life-saving drugs, not the ones selling addictive drugs that don't actually cure your problem, right?
Right, exactly. So essentially, if a company is out there, common knowledge that this company is not going to be productive and this company is going to be doing something to harm people, and let's say there's a narrative that develops either online or kind of in other social circles that actually, you can actually still make money investing in. And that company ends up getting a lot of capital to do more and more and more kind of unproductive or harmful things. I mean, this is a big problem. Then financial markets no longer serve the purpose of being the engines of getting companies to be productive and doing social good. You're kind of getting the opposite of that.
Yeah, I just want to clarify for the listener, it seems like there's kind of two assumptions here that have to both kind of work together. The first is that companies, when they make money, they're actually doing good things to make that money, right? Or at least not harmful things, right? So if you can make money by poisoning people, then you don't want them just funneling more money to that company. They're just going to harm people more, right? So that's the first assumption. The second assumption is that once you have that, you also want it to be the case that capital gets allocated to those companies that actually can use that productively, right? That can produce return from it. Because if you have the first assumption in place, then by allocating more money to the companies that can make more money from it, you effectively benefit the world more, right? And so that's kind of this second assumption, which is about sort of efficient allocation. And these bubbles and irrational behavior in the markets kind of screw up that second assumption. Does that make sense?
Yeah. And I think to the first assumption, it's really important to highlight the role of a strong state, where you have the government being willing to say, look, the capital markets are doing their own thing, and people are kind of buying and selling stocks because they think that they could make money off of these stocks. But we, as politicians, and as the state, we don't want people being harmed. That's why people voted for us in the first place. So we need to make laws and regulation and things like that in order to keep these companies from doing what they're doing. So I think the first assumption really needs a strong role of the state as well, even without this model of Keynesian beauty contests of the stock market. Even the kind of normal vanilla stock market model might still get companies that are doing harm making a lot of money and getting a lot of capital.
Let's shift topics. You co-wrote this book, The Winner's Curse, that is a re-release, but my understanding is it has tons of new content compared to the original. And one of the fascinating things you told me before we started recording is that before actually publishing the book, you went and re-replicated the studies from the book. Tell us about that.
Yeah, so the title of the book is, Winner's Curse, Behavioral Anomalies, Then and Now. And the goal of the book was really to revisit where behavioral economics was kind of when the original columns that The Winner's Curse was based on, which was about ended in 1992 or so, and to ask, is this true?
Yes, we often talk about the replication crisis. And I also just want to point out that over the last, I don't know how many decades, we've been kind of compiling these anomalies where humans seem to deviate from what you'd expect of a perfectly rational agent, right? So you can define all these scenarios. You could say, what would a perfectly rational agent do in this scenario, assuming they have some utility function they're trying to maximize, assuming they can perfectly process information and work with probabilities perfectly, et cetera. And there's just been so many of these anomalies that have kind of been collected. And some people think it's gone too far. Some people say, well, actually, we've kind of way overshot it. Actually, humans are much more rational than all that. We're not such irrational creatures. But yeah, and so I think that's part of what this book is responding to, if I'm correct.
Yeah. So part of what it's responding to is to say, look, the original set of anomalies were discovered in a very disciplined way. They were discovered by saying, here are the assumptions underlying economic models. Let's take these economic models, since we think that they're important, and I think most people agree they're important. They're the kind of bedrock on which policy and We were just talking about financial markets. All of these sorts of things are built on economic models. Let's stress test them in a very kind of disciplined way by saying, actually, this assumption doesn't really agree with this, how we think people actually behave. Let's set up an experiment to show that actually people behave like psychologists think that people behave. I think that's how the original anomalies were discovered. And kind of what we found in the book is that replicating them now directly, all of them hold up.
And that's phenomenal, because it's certainly not true of all areas of social science. There have been all kinds of problems with replicability. And so seeing this hold up, honestly, it doesn't surprise me so much, because I feel like behavioral economics, in my view, has been one of the big bright spots in social science. But it is really cool to see that you replicate it. And, how many books actually go and replicate their studies? Very, very few. So kudos to you.
Yeah, and you don't have to take our word for it. So when you purchase the book, it comes with a bunch of online materials. One of those online materials is not only the results from our own replications, but the materials for you to do the replications yourself. So, the instructions exactly, you go on one of these online crowdsourcing platforms, you upload the instructions. It's pretty inexpensive. You collect the data, you analyze it, do it yourself. So we really want to show that, look, the bedrock of behavioral economics, it's very much sound.
So can you give us an example? What's sort of a really compelling example from the book?
So I really like the first chapter, which is what the book's title is about, Winner's Curse. So let's say you go to a bar with a jar of coins and you say, all right, the person who bids the highest for this jar of coins gets the money from the coins. And you convert them into dollars. You can Venmo them to the person so they don't have to walk around with coins. But everybody bids. Most people bid below the value just because they're risk averse. But time after time, you could do it yourself. The person who wins the money is paying more for that jar than is in the jar. That's called a winner's curse. People lose money from winning. And the cool thing about it is that, one, you can replicate that. The winner loses. But two, it's not just about jars and, auctioning coins. The winner's curse was first discovered by oil executives when they found that, look, every time we bid on wells for drilling, if we win, there's less oil in those wells than we estimated. So systematically, we end up losing. So this is not just the kind of a cute little behavioral phenomenon. It's out there in the world where very, very sophisticated consumers and firms are suffering from it. So that's kind of one of my favorite anomalies. It replicates super well. And it's something that firms need to be super aware of when they're kind of deciding how to bid and things like that.
I once, quote unquote, replicated an example of this at a social experiment that I threw. It's a slight variant on it, but the way it works is there's a certain amount of money and people can bid on it. But the catch, and this is what everyone was told in advance, is that both the winning bidder and the second place bidder both have to pay. Right? So
you make a lot of money with that.
Yeah, exactly. Yeah. So it's like, okay, there's $100. How much are you willing to pay for it? But remember, if you're the second place bidder, you still have to pay. And of course, it keeps getting, for a while, people make bids, but then you end up usually with two people bidding. And, one of them is bid, $70 and one is bid $71. And the $70 person is thinking, wait a minute, I better bid higher because I don't want to pay $70 for nothing. And then they bid it all the way up to, practically 100. I didn't make them pay at the end. It was just to illustrate a point. But obviously that's a twist on what you're describing. But I think that the winner's curse is so fascinating because I think it shows that even though something makes sense, if you think of it as a kind of one-off, I'm estimating this one thing, on average, I'm accurate at estimating. Once you take into account the broader context and you say, wait a minute, the fact that I didn't win this, what does that imply, right? What does that say about the fact that other people didn't outbid me, right? Now you have this extra evidence. The fact that you won sort of gives extra evidence that says, hey, maybe I didn't want to win this.
Yeah, exactly. It kind of feeds into what we talked about before, that you kind of have to think about what everybody else is doing. Everybody's kind of trying to estimate the value of this jar. And some people are like, let's say it's got $15. Some people are like, it's got $13. And they bid like 11, right? Other people are like, it's probably $20. I'll bid 18. I'm still bidding below the value, but 18 is probably going to win you the jar, and there's only $15 in it. So you kind of need to take into account that the more people there are in the room bidding, the higher the chances that if you kind of just take your value and bid according to that value without taking the winner's curse into account, you're going to end up losing money.
Do you see any ways that the kind of behavioral economics approach has gone too far where you're like, actually, the rational actor model was right all along? Like, it turns out that, in this scenario, people weren't actually being so irrational. In fact, maybe they had additional context or additional constraints that we didn't understand at the time. And I'll give you a funny example of this. We were trying to replicate some questions related to the sunk cost fallacy. And we were using kind of, very simple standard scenarios, asking people like, okay, imagine you order a meal and like the meal comes and you realize like, not only do you not like the taste, but you're full, right? Like, do you keep eating it? And like most people would say yes. And you could just stop there and be like, oh yeah, sunk cost fallacy, right? But then we also included questions asking them like to please explain their answer. Why did they say that they would keep eating it? And it turned out tons of them were saying, well, I wouldn't eat at a restaurant alone. So I'm going to be with another person. And it'd be like weird if I'm just sitting there, I don't eat my food. And you realize like they're operating under a different constraint, right? Now, it's not to say the sunk cost fallacy isn't real. I think it is. But it's just like, oh, wait, there's extra constraints that our simple models don't always take into account.
So that's an excellent point. And I could talk about this for 2 hours if you let me. We talk about this in the epilogue of the book. The new wave of behavioral economics is doing exactly what you're describing. Is rather than saying people are stupid, why are they doing this? Is to say, what are the constraints that lead them to behave the way that they are? So, let's say people are making a crazy decision about their mortgage. They get some APR and in the media, they're like, all these people are taking these crazy APR mortgages. They can't pay their money, their mortgages. They're going bankrupt. Are these irrational, silly people? Well, how were they given the mortgage? What were they constrained? Where were their constraints when they were filling this out? You look at these documents. I'm a PhD economist. I wouldn't have been able to figure out what the APR is. The constraint is that I have limited attention. I have a family that wants me to buy a house. I'm being presented with a set of information that makes this super attractive. I sign the paperwork. If somebody told me, hey, here is the APR right now. Here's how it's going to change. This is how much you're going to pay in the future. Most people will say, screw that. That's crazy. I'm not going to take it. The constraints are attention, my social situation, kind of the sophisticated interplay with me and the companies that are really trying to screw me. Taking all of those things into account will lead to what looks like mistakes, but they're only mistakes if you don't take these constraints into account.
Yeah, there are a couple in particular I want to run by you because it seems like there are these waves of research where some kind of bias will be shown in an experimental setting, and then other research will come out saying, well, no, actually, if you really think about it the right way, people are being rational. And so an interesting example of this is hyperbolic discounting, where it's this general idea that if you're thinking about how much is something worth to me, a year from now versus like tomorrow versus 5 years from now, you could think about, well, one way to value it would be to say, well, it's equal regardless of when I get it. But I think we could pretty quickly dismiss that idea because, well, you don't even know if you'll be alive 5 years from now, right? In theory, you may not be alive. So how could it really be worth the same amount to you? So you have to have some kind of discount. And then you can show that, well, what is the shape of that discounting function? You can show that if it's not exponential, then there's sort of theoretical problems that occur that people can actually value something more in the future than they do. They can value like a larger amount of money more in the future than the smaller amount of money today, but then actually change their mind in the middle. So, you want this kind of consistency. So you say, okay, if it's an exponential function, the way that they discount the future is exponential, you avoid these inconsistency problems, right? But then they do a bunch of experiments and they show, well, this is not the way the humans really discount stuff. They use other functions of discounting like hyperbolic discounting. And so, okay, seeming irrationality, right? Interesting. But then, paper comes out and says, well, maybe it's more complicated than that. If you actually assume people don't know the right discount rate, you assume there's some uncertainty in the discount rate, maybe hyperbolic discounting is rational after all.
Mm-hmm. Yeah, so that's a 2019 paper by David Leibson and Xavier Goetz. Myopia, I think it's called Myopia and Discounting, showing that actually uncertainty over future tastes generates hyperbolic discounting.
So results like that, I'm wondering, sort of, do they change your view on sort of how irrational humans are? Could it be that a bunch of sort of the seeming irrationality is like some kind of deeper irrationality that we just haven't understood yet?
Look, I spent 7 years at Carnegie Mellon University. That's the home of Herb Simon, who came up with this idea of bounded rationality. Bounded rationality is this idea that people are not irrational in the sense that they're doing crazy things that don't make sense. They're rational, but they're constrained in how much attention they could pay to something, how much calculations they can make, how much information they have about the future, even about themselves. You incorporate those sorts of constraints into kind of our standard model. All of a sudden, you get what looks like crazy irrational behavior, but it's actually boundedly rational. I'm a big proponent of that view.
I see. So overall, you would say humans not that irrational, not as irrational as they seem potentially?
Doing their best. That's my view of humans.
Doing their best. See, it's interesting because while I find papers like the hyperbolic discounting one fascinating, I actually tend to lean towards thinking that actually humans are behaving very, very irrationally. A lot of that, I think most direct evidence of that is that people seem to do a lot of things, myself included sometimes for sure, where like they just regret it immediately after, and they're just like, what the hell? Why did I do that? That was dumb. Like by my own values, clearly that was not what I should have done. I clearly had enough information to know better. It just seems like a very constant state of the human condition.
You kind of have to unpack all of these scenarios a little bit. So like, I'm constantly making mistakes. But why am I making mistakes? A lot of the time I'm making mistakes because I'm thinking about something else that I think is more important. Right? So I was making a cup of coffee this morning, and I really, really needed that coffee. Turned it on, went upstairs, did something for 20 minutes thinking, oh my God, I'm going to go downstairs and have the best cup of coffee in the world. Go downstairs. There's no water in the coffee pot. Everything's on fire because I've turned the coffee machine on. Everything's hot. It's bubbling. Okay, I made that mistake. I should have put the water in. I know how to put the water in. I did not put the water in. What was I doing? I was planning my day while I was making the coffee. So it's like, people have limited attention. They are paying attention to things that they find most important, things like that. An ex post mistake, Richard and I talk about this all the time. An ex post mistake is not necessarily kind of evidence that you were doing something irrational. Obviously, there's room for behavioral economics, and there's a lot of room for behavioral economics. But I think the principled way of thinking of behavioral economics being a field that basically introduces constraints from cognitive psychology into the standard model rather than, hey, people are stupid. I think that's a better way of doing things. And it has much more explanatory power than just, adding an extra parameter and saying like, look, this doesn't make any sense, but this is how people behave.
It's certainly a much nicer way to do things. It makes people feel less bad about it. Well, how do you make sense of something like astrology, right? We actually ran a couple of studies on astrology. First we ran one on astrological sun signs, like, Aries, Pisces, whatever. We found that they're basically correlated with nothing, which is interesting because you might even think they'd be correlated with something due to just like maybe the time you're born, the summer versus the winter is something. But if there are effects there, they're just so small that like you would need ridiculously huge sample size even to pick up on the effects. So that was the first thing. And we put this out just sort of casually. A lot of people got angry at us and they said, well, that's not real astrology. Real astrology using full astrological charts. So we're like, okay, let's try that. So we actually recruited 150 astrologers. We gave them lots of information about people. We tried to match them to their astrological chart. Not only were they no better than chance, but the more experienced astrologers were much more confident, but also no better than the less experienced ones, right? So it's like, why astrology is really what has huge levels of belief in it, right? It seems like it correlates with nothing. It seems like it seems to be total noise as far as we can tell, right? Like, how do you make sense of something like that?
Yeah, I mean, how do you think about the broader question is like, how do you think about belief systems that are not based on truth? And that people are very confident about and make a lot of decisions based on.
Right, because if they were making decisions based on it, I think it'd be easier to explain. It's like, oh, it's a fun game, whatever, right? But and it's true. Many people in astrology, they don't make decisions. It is a fun game for them. But there's clearly like a sizable contingent of people that take it seriously, and they're like, it's guiding their choices, right? They're using it sort of for advice, they're using it to understand their life.
Right. So, I mean, this gets at, so now we're outside of behavioral economics a little bit. Now we're let's talk about some psychology. I think there's a lot of psychology showing that people need need agency in their lives, need a sense where the world is not this random process where you're in a machine and you have no control over it. You're just kind of making decisions where your effort or whatever you're doing is going to generate some random thing and you're just going to have to deal with it. Like if I'm I don't know any astrology. I'm going to say some stuff that doesn't make any sense. Let's say I'm a Pisces. I believe that this matters. So therefore, on a Tuesday with the full moon, if I do this, things are going to be really great for me. It's kind of comforting, right? That generates positive utility. This belief in something that it's definitely not based on any truth. If I believe in it, it calms me down. It gives me agency. It gives me some sense of control over my life. And if, that feeling, it's going to, believing in the system obviously leads to some mistakes, but also believing in that system could generate a better mood than the counterfactual of not believing in the system.
Yeah, and I think you hit on a very important point, which is that it's not just truth that we are maximizing, right? Even the perfectly rational agent wouldn't be maximized just for truth. They have some utility function, which, maybe truth is part of that. But I think where it gets a little funny is that if you do this non-explicitly, like it's hard for someone to be like, well, I know X is true, but I'm going to believe Y anyway because it's better for me, right? It's very hard to do. I don't know if people are capable of doing that. Maybe some are. But so if you can't do that, then you sort of have to implicitly be valuing the thing while simultaneously like believing it's true, but not believing it's true. You know what I'm saying? In order to come to say, that it's actually better for me to believe in this false thing.
Right. Kind of like a cognitive dissonance sort of thing where you're holding two beliefs at the same time and they're conflicting and you just kind of have to like live in this space where you're flipping back and forth. I think people certainly do that. I wanted to kind of also kind of segue into saying like, I don't think people are like hyper rational and everything is rational and everything makes sense. I just kind of want to put a little bit of water in this idea that people are just out there doing crazy stuff all the time. I think in going into psychology, we have evidence that people are holding multiple beliefs. Like I'm from Eastern Europe originally, and the idea of holding two completely, basically double think. That's like the whole system of the government. In the Soviet times, you're supposed to hold the belief that we're a communist nation and everything is democratic, but at the same time, if you say the wrong word, you know where you're going.
That's dark. It does seem to me that belief in humans is like much more complicated than kind of the simple, you believe something, you don't believe something, right? Like you can kind of know something on one level, but be in denial, like maybe their partner's cheating on them and like, they kind of know it, but yet they never allow themselves to have the thought of it, but maybe in some ways it influences their behavior. So yeah, it just seems like we need a really rich concept of belief to make sense of these phenomena.
Yeah, for sure.
Jumping to a new topic, AI is becoming a much bigger part of people's lives. People are using ChatGPT and Anthropic's Claude all the time now. What do you think the effect of this is going to be on people's biases and decision-making? Like, is this a good thing? Or is this going to actually just make us worse thinkers?
So, there's this kind of has a parallel to what world we're living in. If we're like in an ideal world where people know what their biases are and they know that the AI kind of has more information, knows what to do, is super intelligent, we kind of live in a better world, right? Because people say like, look, these mortgage forms are super complicated for me. And it's going to be really tough for me to go through them. I'm going to put it through Claude. The Claude is going to tell me everything that's going to happen. I'm going to make a better decision. And in that world, AI completely eliminates biases, right? But we could live in a different world where AI is actually being used by companies that are trying to take advantage of people. And now, they used to be able to take advantage of us in a very kind of crude way because they didn't have a lot of information about any individual. They just kind of had to like put something out there and see who bites. But AI basically allows companies to build models of individuals given the data that they're freely providing on the internet. And these companies can now kind of exploit biases on a very, very, very micro level, which leads us to be living in a much worse world in terms of biases.
Oh, okay. So it sounds like we're talking about two different kind of types of AI, right? We've got LLM chatbots where people may be talking to it, maybe asking it for advice, that kind of thing. And then we have more like AI prediction models, like, TikTok trying to predict what video to show you, or Amazon trying to predict what product you're going to buy. And there they might be sort of active incentives to kind of create biases, like or exploit biases. Is that what you're getting at?
Yeah, that's exactly right. So I'm classifying both of these things as AI.
Right. Because even with things with LLMs like ChatGPT and Claude, there's a big problem, I think, of these models kind of reinforcing our own biases, right? Where instead of, in an ideal world, they might call us out on our misconceptions. In practice, they're trained with human training data where people say, literally in the training process, they're going to show different examples and say, which of these do you like better? And people tend to like things that reinforce their own beliefs, even if those beliefs are biased, right? And so we had this big problem with AI sycophancy, right, recently, where they had to kind of roll back some of that because it was kind of getting excessive.
Yeah, the human part of reinforcement learning, where people are kind of sitting down and saying, look, we don't want the model to do this. We don't want the model to do this. We don't want the model to do this. Unless that's kind of built into the process such that the model is not propagating biases, then it will. It's going to have in the model, if you prompt it to say, give me the unbiased opinion according to this model, which absolutely nobody's going to do. It's going to be able to tell it to give you that. That's what I mean by like being in a fully rational world where people are aware of their biases. If a person's just like, which one of these things am I going to like better? You put that in an LLM and the LLM wants to please you, then you're absolutely going to perpetuate biases.
I have custom instructions I set up permanently for my LLMs. And it includes 3 of the lines in it are: call out my misconceptions, be brutally honest, never sycophantic, and tell me when I'm wrong. And, I posted these online being like, I think this really helps it be less sycophantic. Like I found that it is much less likely to compliment me, more likely to disagree with me, which I think is really healthy. But someone else copied this into their LLM, which is a different LLM. And they found that it was actually making fun of them and telling them that they're a fool. And I was like, okay, maybe I pushed it a little too far. And so you could see why people don't like instructions like this, right?
Yeah, for sure. We don't really quite know where things are going to go. I think with the AI broadly, unless there's like some sort of state intervention, I think we kind of know where things are going to go. We're going to have just system-wide third-degree price discrimination all over the place.
Yeah. So could you elaborate on that? Like, what is price discrimination, and how does AI get used for that?
So let's say you're kind of in a world 20 years ago. Let's say, you're trying to buy an Apple iPhone, and for you, the maximum you're willing to pay for it is $2,000. You really like it. For me, it's $1,000. That's how much I like it. There's a bunch of consumers. Let's say they have prices all over the place, supply equal demand. There's one price. Let's say it's $1,200. You go out there, Spencer, you buy an iPhone for $1,200. That difference between your willingness to pay and the price, that's your consumer surplus, right? That's because Apple is not giving you a Spencer price. It doesn't know what your price is. All it knows is supply and demand, and that allows consumers to have the consumers who have values greater than the price to get surplus. What is AI doing already in these online settings? It's building a Spencer model that knows your willingness to pay. So when you go out and buy something, it's going to give you a different price than me. And that is third-degree price discrimination, where people are going to be getting different prices depending on their willingness to pay, and that eliminates consumer surplus.
Sorry, what does third degree refer to there?
Third degree, that's just the type of, because there's more illegal types of price discrimination. Third degree price discrimination is just the terminology for that type of price discrimination.
And is that legal in the US?
Some versions are legal, some versions are not legal. But the sort of thing that if you're going by kind of particular groups, like for example, I know I'm not going to put every single thing into my model, but I'm going to put certain things into my model. Depending on what I'm putting in, that becomes legal. And those certain things that I'm going to be putting into the model might be super predictive of your willingness to pay.
Right. So presumably it's not allowed to say, well, you're a white person, so I'm going to give you a better price, right? That's surely going to be illegal. But if it's using, let's say, information about your past purchasing behavior or something, maybe it's allowed to do that?
Yep, exactly.
So you kind of pointed at this economic argument a little bit. Obviously, people generally feel it's unfair when they get different prices. Like that's a common thing saying that's not fair. There are cultures where that's not true. Like there are cultures where it's very common to haggle for goods, right? And you can say, well, if you have a relationship with the storekeeper, or you can make, you convince the storekeeper you're not willing to pay more than X, maybe they'll give you a discount or whatever. So, whether it's sort of fundamentally wrong is sort of an interesting question. Maybe there's some cultural aspect to that. But you also pointed the economic issue, which is that, there's a certain sense in which the market price, when there's one market price, is optimal. Well, can you tell us, what is that sense in which it's optimal?
It's not optimal in the sense that, there's something in economics that says third degree price discrimination is quote unquote not optimal. There's this idea of Pareto optimality, where, this is optimal because there's no way for us to move to a different system where everybody would be better off, and nobody would be worse off. Because let's say you move from the one price version to the full third degree price discrimination version, that's not Pareto. That's not a Pareto improvement because the company's hurt.
So is the fundamental issue that this is a way that companies can basically move consumer surplus, so like basically benefit to the consumer to benefit to the company? So it's not that it's a non-optimal way of doing things. It's just that it screws over consumers at the benefit of the company.
Exactly. So it's just how surplus is divided, and how surplus is divided. That's not an optimality thing. That's not an efficiency thing necessarily. That's a normative thing. That's us as a society saying, look, we don't want this to be happening. We don't want companies to be getting all of this market surplus.
And insofar as companies do get most of the market surplus or all of it, it really undermines the whole like benefit of capitalism, right? Because the whole point is that companies should be producing things that are valuable to society, and that's why they get rewarded for it, right?
I mean, yeah, I could talk about this for hours. I mean, capitalism is like a catch-all term for a lot of different things. There's like really, really bad capitalism that you do not want to live under, where one company makes all the products and employs all of the people and takes all of the surplus and, has everybody's paid at their cost of effort, and that's it. Not anymore. People are getting, they're not getting any surplus from buying anything because prices are set at a certain way. That's capitalism. That's still capitalism. I don't think anybody wants to live in that world. The places where the type of capitalism that people want to live under has a strong regulation, because there's no monopolies or very few monopolies. There's a lot of competition between companies for both workers and products and things like that. And that's just a different sort of capitalism. And also, you don't have too much of that third degree price discrimination, so people can have some of that surplus.
So what do you think the solution is? Should it just be made illegal to do this?
I think regulation. I think that's the only way that we can ensure that people have consumer surplus, is to make sure that companies are to the best of our ability. Right, regulators are always going to be behind tech companies as far as what they can do, but they could try a little harder.
Do you see other big ways you think AI will have an impact on sort of decision making or biases that people have?
I mean, all I can say is that it's going to have a huge impact. The direction of that impact, I think I don't want to make any strong bets. I can see it kind of going either way. It really depends on kind of the regulatory framework of what politicians are willing to do. It depends on how AI companies decide to kind of put these products into the world. So, it could be that people kind of get burned by these things and see that, look, every time I use it, like we're in the LLM world. Every time I use it, I kind of get screwed a little bit. I'm going to stop using it. Companies don't want that. So they might actually incorporate safeguards, do some more kind of human reinforcement learning after training these models to make them better for decision making. So that's certainly a state of the world. It's just really hard to predict. The world is moving under our feet.
One thing I've noticed very recently is people using LLMs to argue their side of an issue. And so I've started having people post on my Facebook posts like, you're wrong. And then it's just a list of like an argument clearly made by an LLM, but where they basically told the LLM, it's very apparent, like, prove why this thing is wrong, right? And of course, if you do that, it will always give arguments on the side that you tell it to give arguments on, right? So it's an interesting kind of dual use sort of a cognitive bias technology, right? Because you could just as easily say, argue all plausible sides of this issue, right? Or you could say, argue the side I disagree with, or you could say, argue the side I agree with. And like, depending on which of those usages you do, it could make you less biased, or it could just massively increase your own bias.
So it's actually kind of cool because, I'm an active user on X or Twitter, or whatever you want to call it. And at first I was like, having Grok in there, I was like, this is going to be kind of creepy. But then what I've started noticing is all these people saying crazy stuff online and then saying something like, Grok, am I right? Or somebody else coming in and say, Grok, is this person right? And Grok being like, this person's wrong. And that person being like, because it came from this like third party arbiter, all of a sudden they were actually able to kind of shift their beliefs kind of in the right direction. Now this gets into like, how often is it going to be right? How often is it going to be wrong? But there's actually evidence by David Rand and some colleagues showing that LLMs do have this potential to debias people exactly in this way, where people kind of have these conspiracy theories and then they interact with the LLM, and the LLM kind of pushes back in a way where people are not as defensive as they would be arguing against another person, and beliefs actually kind of converge closer to the truth.
Well, it certainly helps if you're discussing someone with something, if you feel like it's on your side, right? If you feel like it's from a out group, or, that this person doesn't have good intentions towards you, it makes it very hard for those to be productive conversations. So if someone views the LLM as just sort of this helpful agent and doesn't think of it as like trying to do something to them or trying to manipulate them, maybe that opens them up more to like hearing counter arguments.
Yeah, exactly. When you're arguing against somebody, you kind of have this assumption that they're trying to get me, or they're trying to they're from the other tribe. I don't think that people have that as much with LLMs. So they're kind of moat for having opinion, incorporating information is more open than it would be if they're arguing with somebody from the other side.
Yeah, I guess something that's been making this more complicated is that Elon Musk and some others have been claiming that LLMs are like biased towards the progressive side.
Exactly.
And then hence we get Mecha Hitler and other unfortunate things like that. But yeah, then that could foment sort of people's distrust of LLMs. Not to say that you should trust LLMs, but just that could make it harder for them to act as neutral arbiters. And in fact, just the other day, for the first time, I saw an LLM that was explicitly being advertised as being a conservative LLM, where they're like, it's like, oh, this is going to be biased in this particular way, rather than trying to market as unbiased, right?
This is something that could happen, right? This is kind of like my support of things that could actually happen, is that we go from having these broad models like what Grok is now and what like OpenAI has now. Instead, we go into these balkanized models that are trained for specific purposes. And there you can get into some wild space where you can have like, again, that's a great example, a conservative LLM, or like an LLM that's trained on, Mein Kampf or something like that, right? And these super racist LLM, and people using these LLMs as arbiters for themselves. And that will completely spiral bias into a very, very different world.
Yeah, you could certainly see why, if you had certain foundational beliefs about the way the world works, you would want an LLM that like supports those sort of as your basis. For example, let's say you're deeply religious and, you want your LLM to like reflect the religious values or truths that you think you have, right? So it's not so implausible that people will kind of eventually end up kind of splintering to their favorite LLM that sort of reflects their worldview.
Yeah, exactly. Like if we write down a model that people's utility from having their beliefs upheld is higher than anything else, then there will be a market for these like balkanized LLMs that will get us into a pretty weird space.
Shifting topics again. So let's talk about how behavioral economics affects some of the kind of issues of the day. There's been a lot of talk about tariffs, and, there's, economic analysis of tariffs, which, please correct me if I'm wrong, but as I understand it, generally tariffs are thought of as inefficient. Like basically you're preventing people from buying things, or you're raising costs. And so from an economic point of view, it's often inefficient. Well, what does behavioral economics add to this conversation?
So there's a couple of things that are interesting with by thinking about behavioral economics and tariffs. So one is kind of simple. So let's say you are a pretty powerful country like the United States, and you have a relationship with the European Union or countries in the European Union. And then you say, like, look, I have the upper hand. I'm a powerful country like the US. I want to make some money from our trade. I'm going to impose a tariff. In a one-shot case, if you're just kind of a businessman and you're not really working with people over a repeated period of time, you're going to make some money. The problem with things like tariffs and international relationships is that these things are repeated games. So if you're thinking about, I'm putting in a tariff, the other country can't do anything but accept it. There could be a time when you need help from that other country, or you need some sort of alliance with the other country sometime down the road against, another adversary or something like that. Doing something like this where you actually exploit your negotiation position will make it less likely that that country is going to cooperate with you. So there's something called the ultimatum game that we talk about in the book, where essentially, me and you are in a scenario. I have $10, you have nothing. I offer you some money from that $10, and you say whether you accept it or reject it. And let's say I offered you 1 cent. Standard economics says, Spencer, you should be really happy with that 1 cent. It's better than zero. You accept it, I get $9.99. What happens in reality? You don't accept it. And actually in that game, both of us end up with nothing. You would prefer for both of us to end up with nothing than for me to kind of generate this kind of unfair offer. And this sort of like retaliatory motive is very present not only in individuals, but it's also present in world leaders. So that's kind of like one risk with tariffs is, we're going to be making some money off of it, but we're really ruining our international relations.
Yeah, it's interesting. It's sort of this idea of someone who's a pushover, where people can take advantage of them and then they're not going to retaliate, versus people that are, let's say, irrationally retaliatory, right? I'm putting irrational in quotes here, where you're like, well, everyone knows if you fuck with that person, they're going to go way over the top and do things that are like not even in their own interest, right? Like they're gonna like, chase you to the ends of the earth to harm you, even though they're gonna end up in jail, right? It's like, well, okay. So on the one hand, that is very irrational to be so retaliatory, because like in a local case, it might actually cause more harm to them than it's worth. But on the other hand, nobody who knows about that is gonna mess with them, right? And so that there's this meta way where it's solving a problem for them. And I hear, there's one thing that I think people talk about with regards to things like gangs, right? If you live in a really poor area where there's a lot of danger, and joining a gang is like a way to sort of buy yourself protection in a sense, and saying, don't mess with me because you're going to regret it, right? Now maybe it's not worth the cost. There's huge costs to joining a gang, but it's like you're sort of like, you're changing the landscape of like what is going to be offered to you and what's going to happen to you.
Yeah, absolutely. I mean, thinking about gangs, it's like there's I'm blanking on the name, but there was like a sociology book written about the Chicago gangs. And these are completely fully rational, like crazy, organized bureaucratic structures that are keeping up. The state has failed these areas. What crops up in these areas is a way of solving the lawlessness and craziness in these situations. So when you're living in these sorts of areas, joining a gang is a kind of a, fully, I don't know if it, you have to look at the parameters, but it's a rational decision.
Right. I mean, I think gangs can create all kinds of problems. So it's not the way we want society to regulate.
Exactly. That's why we need the state to come in and, provide the infrastructure so people don't need to join gangs for safety.
I wonder, so you mentioned the ultimatum game, and there's a bunch of these sort of economic games that are designed to sort of abstract some aspect of human interaction or relationship or game theory, and then kind of draw conclusions about it. To what extent do they really generalize to real human behavior? Are they kind of too abstracted away, where it's like, yeah, sure, you can prove that in an ultimatum game, but what the hell does that say about real life? Or do you think it actually captures enough about real human behavior that it's useful?
Totally depends on the game. So there's some games where I think they're just so abstract that what are we even learning from them? So I think like if you're using something called the dictator game. So the dictator game is like the ultimatum game, but the other person just has to accept your offer. So let's say I have $10 and I give you a cent. That means you have to take the cent and I get to keep $9.99. Kind of the stylized fact from those games is that people still give some money. They give like $3 or $4, right? And you could interpret that as saying like, whoa, people are so generous. Everybody's kind. We live in this like, universe of altruists, I don't think that has a lot of external validity. Just because, we were talking about the kind of social context and social constraints. You're put in a very, very specific scenario. You are with a person who knows who you are. Abstractly, obviously, everybody's anonymous, but you're in a social scenario. It feels really weird not to give any money. But in the real world, you can cross the street. You can not open the envelope with the Salvation Army sticker. You could do a lot of things just to avoid that interaction. And so what you're going to see is a lot less giving. And that's what the follow-up experiments actually showed, is that the dictator game, when you introduce these other kind of socially complicated aspects to the dictator game, giving goes down to almost zero.
Insofar as these games represent reality, they're so useful because it's like a little microcosm to study human nature. But then as soon as they get too far adrift from reality, from like the real things that happen in real life, it can actually go the other way where you're drawing false inferences about the way the human mind works.
Yeah, so a really good example of that is like Vernon Smith has these classic market experiments, which it's like magic, where like a group of people is given like, this is how much you value a product. You get a card and it says 7. That means you're willing to pay $7 for it. So if you pay 6, you're actually very happy about it. And then you get like 1 through 10 inside of a room. The other side of the room are the sellers of the product. They're also given the value that they have to the product. This is the minimum that you're willing to sell it for. You put them in a pit market. From these numbers, by the way, you can kind of trace supply and demand. There's an equilibrium price that you can calculate. It's like magic. I run this stuff in my class all the time. Jaws drop. You get to the equilibrium price. Beautiful. It seems like standard economic theory is correct. Wow. Here's the beauty that, we discussed this in the book. Richard Thaler published this with Danny Kahneman and Jack Netsch. Replace these cards with actual products. Replace it with mugs, pens, anything else, right? Do the exact same exchange. Doesn't look very beautiful. What ends up happening? People who are endowed with a product all of a sudden don't really want to sell it for the same price that they would be willing to buy it for. So if I randomly allocated a bunch of mugs to one side of the room and asked them, what is the minimum that you would need to sell it? Turns out it's almost 2.5 times higher than people are willing to pay for it. So trade really kind of breaks down. You're nowhere near that equilibrium price.
Before we wrap up, I want to go back to the tariff question we were just discussing, because standard economic theory says that if you have tariffs, it's going to tend to increase prices. You would think that people would hate that and they would not support tariffs. So does behavioral economics have something to tell us about this?
Yeah, so there's some new work that I've done with my colleague, Christoph Madaras and Heather Sarsens. And basically what we found earlier is that we talked about the dictator game where everybody's super altruistic and things like that. What we found is that actually if you kind of conduct experiments where you test whether people, how much they value a product when other people want that product but can't have it, that actually increases their valuation of the product a lot. And what these preferences do is imply that they value exclusionary policies, where you have a policy that keeps somebody out from the market that really wants to be in the market that you have access to. So what does that imply for tariffs? That implies that people will actually be willing to kind of bear inflation costs as long as they know the tariff is kind of keeping somebody else out. And we have evidence for that. Basically, we collected data on people's support for a price increase because of tariffs or a price increase because of stimulus packages or sorts of a bunch of other things. And we correlated it with this basic preference for dominance seeking, which is what we call the preference. Turns out there's a super high correlation. People are much more willing to accept price increases as long as they know that that price increase is kind of keeping somebody else out from what they have. And what this suggests to us is that, again, people are not kind of miscalculating or doing something stupid. They know the consequences most of the time they kind of implicitly know the consequences of tariffs. They're just willing to bear those consequences given kind of what it's going to do to the rest of the world.
Is this related to the phenomena where people love to be inside a club that has a long line outside, but if there's no line outside, it's less enticing?
That's exactly what we explain using those preferences. We take those old papers trying to, Becker wrote about this in 1981. Why are there long lines in restaurants? It's an economic puzzle. Why do, the restaurants should add more seats? And what we show is that actually, if the restaurant added more seats, fewer people would come, because the reason you want to be in that restaurant is because of the line.
Something I've been thinking about a lot lately is how much of irrational human behavior actually is social, where you think about it as like, oh, you're making decisions for yourself, but actually you're kind of taking into account the behavior of everyone else and the beliefs of everyone else. And in doing so, it can really, really change things. Like earlier in this conversation, we talked about how, well, if you think other people are going to highly value a company, maybe you should buy it because maybe it'll go up because other people value it. But you're not actually, you're like doing this social thinking instead of thinking for yourself. And similarly, it's like you're taking into account, well, do other people want to eat this at this restaurant, rather than just saying, well, how much am I going to enjoy the food there?
Yeah, so we in the original paper, we kind of made a strong claim that preferences are largely mimetic. Mimetic is in they're based on what I think other people's preferences are. And I think we have some decent support for this as far as the sort of context effects that we have for preferences. George Lowenstein and Dražen Prelec have this paper on coherent arbitrariness, where you could kind of move demand curves all over the place just by giving people social signals. I think we have a decent amount of evidence that's exactly right, that we as economists are really underestimating the effect of social forces and preferences.
Interesting. It reminds me of, I think it was it René Girard who had this theory that
Yeah. That's right.
Yeah, maybe you could explain what was his basic theory, and to what extent do you think it's actually scientifically valid?
Yeah, so the original title of the paper, and I'm just telling you and the rest of the audience that the reviewers made us change the title of the paper, was Mimetic Dominance and the Preference for Exclusion. Mimetic is from Girard. He had this mimetic theory of social relations, and we provided empirical evidence that he was largely correct, that people's preferences are based on what they think other people desire. That's his kind of social theory. And in his kind of main point is that you need institutions in order to tame the very bad implications of people having these sorts of preferences, as far as the destructive tendencies that people have. And what we show in the paper that he's exactly right. If you take these sorts of preferences that we empirically validate to their limit as far as what people will want within their society, you really need a state to say, look, we don't want, scapegoats and all of these sorts of things that Girard was talking about.
Yeah, it seems like very bad for society, for everyone to want the same things, right? Because a limited quantity, and then you're going to run out of the thing, and some people are going to get it and some are not. So if people are copying each other's preferences to a significant extent, you're going to have this sort of herd effect where lots of people are unsatisfied and you're trying to get the thing, but only some people can get it. And it also might create social friction as well.
Well, what you're going to have is people wanting exclusionary policies to say, look, I know that everybody else wants this thing that I want. And I actually think that they want it more than I do, which makes me want it even more. I'm going to enact leaders and policies that are going to keep them out or discriminate against them and things like that to make sure that they can't have it. That's kind of the natural implication of these sorts of preferences, is things like protectionism, nationalism, and all of this sort of stuff.
I see. So the idea is that if you actually feel good excluding others from things you have, then you're going to say, well, let's add more protectionist policies around my country, and then it kind of makes you feel good about yourself or about what you have.
That's exactly what we find.
That's interesting. To what extent can this be explained through just political preferences, like, left versus right divides versus as sort of as an individual difference, like something that, is about the specific person?
You know what? We really didn't find any kind of political differences in the data. It seems like an individual difference. We find that between 30 and 45% of people are just have a strong preference that kind of aligns with this idea.
Oh, that's really fascinating, because I think can be a confounder in some of this kind of research, which is that it's like, it just happens at this point in time that this political group is in favor of this thing and might also share this other trait. So I think it's actually, to me, it makes it more compelling that it's not just linked to political views, that it sort of seems to be about the individual.
Yeah, I mean, so the way that we measure it is like, let's say I used to be a amateur artist and I have these paintings that I never did anything with. So I use them in an experiment to just sell them as because you need a product in an experiment to sell. And in the experiment, basically you have people and they're told, look, how much do you want to pay for this painting? We're going to make prints of it. It's very limited edition. There's 3 other people in your group. How much are you willing to pay for it if we tell one of the people that they can't buy it? Doesn't matter how much they want it. What about 2 people? They can't buy it. How about 3 people? They can't buy it. Turns out there's people who have a very, very sharply increasing slope in willingness to pay as a function of how many people are excluded. Those people support tariffs.
Oh, wow, that's fascinating. And what's the name for that trade again? You mentioned it before.
Dominance seeking.
Dominance seeking. Really? Are there other aspects to it? Do they seek dominance in other ways?
So this is a research agenda that we recently started. So that's kind of what we're trying to do. So the tariffs paper is going to be coming out in a couple of weeks, showing that it correlates with protectionism. So for example, we can give you a scenario with tariffs. And in one scenario, China or whoever country is hurt by the tariffs. These preferences are super correlated. But there's another scenario where China is not hurt by the tariffs. They find another trading partner. All of a sudden, people don't like tariffs anymore.
Oh, interesting. Because it doesn't,
right?
It doesn't really exclude them from getting the thing they want.
Exactly. So, we find that it explains these sorts of dynamics. Right now, we're trying to figure out. We're doing studies on like whether these sorts of preferences are related with the resentment, like having something that other people want and can't have, and then losing that ability. So resentment is kind of a big study in political science of what happens in the Rust Belt and things like that, where people used to have, something that they valued a lot, and through policies, a lot of people couldn't have those things, and all of a sudden they don't have them. What happens to their preferences, and how do they lash out? So that's kind of future work.
So final question for you before we finish. Mm-hmm. What do you want people to keep in mind about rationality? You've spent all this time thinking about this topic, and there's a lot of different perspectives out there.
That rationality takes on different faces. So things that don't seem rational and seem crazy, if you kind of take into account people's constraints and the complexity of real world decision making, all of a sudden something that seems very irrational makes sense.
Alex, thanks so much for coming on.
Thank you. Thanks, Spencer. This was great.